Good day, good day. Good afternoon, ladies and gents. Trust you well and enjoying a nice start to the short week. Hopefully I'm coming through loud and clear and you can all hear me and see me okay. So what we're going to look at in this midday mentoring is company valuations. So the science, the logic, the algorithm, the equation behind how to actually effectively value a company, either to purchase or to sell. Obviously, if you're purchasing, you want to be able to justify the lower valuation. If you're looking to sell, you want to understand how to maximise the company valuation. How you doing, Dan? Harchand? How you doing, Kaval? What we want to do is understand how does this actually work. So the reality of being an entrepreneur is you're building different types of companies. How you doing, Chris? We've got cash flow, profit, asset, 3 different types of businesses, and they'll all have very different characteristics and very different attributes to them. The sobering reality is you can be a gazillionaire on paper. Like, you can be a gazillionaire on paper, but until the cash is in the bank, it really doesn't mean anything. And it's not actually, how you doing, Michelle? Good to see you. You can be a gazillionaire on paper, but until that cash is in the bank, it really doesn't stand for a huge amount. Selling a company is where you can actually crystallise your return. It's where you can actually liquidate an asset. It's where you can turn that long, hard effort into cold, hard, tangible cash. One of the reasons we talk about building businesses is because it creates another layer of value on top of something you're already doing. So, for example, if you run your own portfolio and you're a one-man band landlord running your portfolio, you've got the asset value in the properties, you've got the cash flow that's released from the properties. But then if you put a layer over the top for, say, example, a portfolio management company, you're doing the same activity anyway. You can make it cost plus neutral by doing it for other clients. So it's not a cost to your business. It's actually arguably neutralising it or adding additional revenue. And then also it holds an asset value. So you could actually sell the operation on top of the portfolio for another layer of profit. How you doing, Tony? The thing to understand with company valuation, so there's a few different ways. In fact, there's a million different ways to value a company. I'm going to give you 3 different things to consider today, and then I'm going to give you an insight into how to value your company specifically. So the biggest thing to understand with company valuations and company sales is a company's not worth anything until the money is in the bank. Whether you're selling shares, whether you're liquidating, whether you're exiting, a company's not really worth anything until the money's in the bank. That's called notional equity or notional asset or notional profit. On the balance sheet, it might look good, but in reality, it's not worth anything until there's cash in the bank. You can be a gazillionaire, trillionaire, billionaire on paper, but until that money is cold, hard cash in the bank, it's all notional because it's not tradable as a business unless you're going to sell shares, things like that. The first thing with company valuations to understand is everyone thinks that you go to an accountant or you go to a business broker or you go to somebody who's in the space of M&A and you ask them to value your business. The reality is there is no how you doing, David? There's no hard, cold, fast way to value a business. Like, a business is only worth what somebody is willing to pay for it. That is the ultimate valuation for your business. So try and think about your logic. It's not like trading a property where you have a market value and at the right price it will sell. Your business is only worth what somebody's going to pay for it. Now, this could be a good thing and this can be a bad thing. It can be a good thing in the fact that some people will pay you a very, very high inflated value for your business, which is far more than the open market value is worth. Equally, some people might pay significantly less than what you think it's worth. The opportunity for you is to find in your market who is the best person, the best placed person to buy your business, and then go and obviously essentially sell it to them. How you doing, Jatinder, David, Raj? There's 3 different ways for you to calibrate company valuations. These are the 3 that I'd encourage you to consider, like, as you're starting to have this conversation with yourself. You might not want to be selling now, but it's always good to know on your balance sheet what you think your company is going to be worth, because then you can invest against, borrow against it, invest into it, understand if it's actually worth investing anything into as a company. The first one is basically, if we call this the investment model. So, and by investment model, I mean the return on investment model. So a return on investment valuation is where an investor is going to buy your business based on the ROI that it's going to generate. So somebody's going to buy your business based on the money it's going to make them. And this is a basic ROI acquisition. The way you look at it here is in the same way you would a commercial valuation for a HMO property or a high density block of flats, an asset that delivers annual dividends, anything that releases money. An investor will buy that asset based on the return that it delivers. So for this model, your company will be valued using the investor model, so the return on investment model, or as a multiplier of profit. So there's lots of different types of profit in your business. Most company valuations, especially if you're going into the semi or full corporate space, use a mechanism called EBITDA. So earning before interest, tax, amortization, depreciation and amortization. That's basically your profit after you carve out all of the acquisition costs, growth costs, non-operating costs, things like that. And that gives you an annual profit, that'll give you an annual profit that your business generates each year. And let's say that's, for round numbers, £100,000. If your business is set up, it's systemised, it has no need for you to be involved, or if it does, you are going to stay in for an earn-out period on like a consultancy contract or as a managing director, something like that. Using a multiplier valuation for an investor, they will pay a multiplier of the profit. Now, multipliers in most markets range between 1 and 4 to 6 in the current space is a good place to be. If you can get an EBITDA 6 times multiplier, that's a reasonable space to be. And what this means is somebody's going to buy your business and pay you, say 5 or 6 times profit, so 6 years profit. They're going to pay you 6 years profit for the business. Now, the logic being that they haven't got to build your business, so there's lots of different logics. One would be that they haven't got to spend the next six years recruiting sales teams, testing the market, spending loads of money on sales, marketing, acquisitions. They can buy it, and then the first 6 years profit is used to pay for that business. So this is the first mechanism, which is basically return on investment. It will be a multiplier of the profit. It does depend, so multipliers go up in different levels. If you're just if all you've got is an order book, that might be 1 year's profit because the clients can leave, there's no retention on the contracts. If there's higher retention, you get a higher multiplier. The entry level ones are things like revenue, profit, customer book. As you start going up into, say, the 2s, the 3s, that's like your operations, your systems, your processes. As you get into the multipliers of, say, 4, 5, 6, they're things like brand, reputation, scalability, infrastructure, all of these like things that are harder to replicate or expensive to replicate. That will give you an indication of what somebody will pay you based on on a multiplier of the EBITDA. So they're looking at your business as an investment primarily, and they'd rather buy it than build it, really. That's the first way to look at it. So a multiplier of EBITDA, which is a multiplier of profit. The second one, which is, if you can find this, can be very, very valuable. And this is where, when we say that your business is only worth what somebody's going to pay for it, if you can find this is where the upshot works for you, because some people will pay more than others. Some people will pay more than you think it's worth. Some people will pay more than the open market value. If you think about this is where you get what's called the marriage value. And what this means is there's somebody in your market, whether it's competitor, supplier, investment fund, somebody that's in another part of the sector that's looking to vertically or horizontally integrate. There's somebody in your sector that say your business is worth £1 million. If they bought, it would be worth £1 million to somebody else because it's 6 times multiplier. However, if this other company that you've identified bought it, once they own that company, it would give them access to another market, or it would allow them to absorb a margin of their supply chain as well as the profit. It might give them a streamlined production chain. It might give them additional value to their processes. It might open them up to a market they don't currently operate in. It might take a future risk out of the business. It might give them a market share to enable them to monopolise. There's going to be specific reasons why some people would pay more for your business, and this is because of what's called the marriage value. A good example of this would be like in planning, those of you that have done development, so if you're doing you see it with pubs all the time, pubs or something that's off the beaten track of the road, where you buy a plot of land, you do the build, or you buy the plot of land to get the planning, and you might pay 300 grand for the plot of land to put the houses on, but then there's an access road that's owned by the bungalow on the main road, or it's owned by the local council, or it's owned by the house next door, and it's not part of that land. That as a piece of land per square foot, say it's like £150 a square foot or whatever the open market rate for that land is, you might pay £300,000 for the plot, the pub that you're going to put 20 houses on, but you might end up having to pay another £200,000 for the tiny little strip of road to get to the back of the pub. And this is called the marriage value. It means that little bit, that business there, that plot of land there, that strip there, is worth significantly more to the person who wants to build the house on the pub than it is to anybody else in the market, because it's an access road. The marriage value there is significant, so that's why people get a premium for that. James Caan is another good example. In Brick Lane to Dragon's Den, which is James Caan's Dragon Den book, he talks about when he was selling his recruitment company. He was selling it for I can't remember what it was, 150 million. And they were approaching exchange, they'd done a deal, and they were going to sell to this European recruitment company. And then somebody came in at the 11th hour, a consultant, and said to James Caan, if I can get you more money you're undervaluing this business. Whereas he'd had offers from all around the market. He said, if I can get you more money for this business, would you allow me to take a cut? So James Caan said, yeah, anything you get above what I've already accepted, I'll take a cut. What this guy then did was he then went to the people that James Caan was going to sell to, and he said, when you acquire, I can't remember what it was called, it was like recruitment franchising company. When James Caan sold to these other recruitment companies, they then acquired James Caan's company, and that then made them the biggest network of recruitment companies in the world. So the marriage value there, by market share, by positioning, became significant. So he could actually introduce, he had the value of that company. The value of that company, when they merged together, they would, the sum of the masses would be worth more than the parts. 2 + 2 = 6. They then renegotiated that element of marriage value, which would have been added to the balance sheet of the target company. Of the acquirer of the target company. And then he earned another £4 million as a fee for putting together the marriage value. If you can find somebody that will pay a premium for your company because of X, that can be very good. We acquired an agency recently. We've done a number of acquisitions, lots of different ones. We've done mergers, we've done acquisitions, we've done share sales, we've done share purchasing, we've done licensing agreements, we've done partnership agreements, we've done deferred payments, earn-outs, we've done loads of things. 2 agencies that we bought recently, so we've done 3 acquisitions so far this year, and 2 of them were in new markets. One of them we were prepared to pay a premium for because it meant that it would complete our national network of the target areas we wanted to go into, and the opportunity to grow in that market was higher. So we had an opportunity there. We agreed to pay a premium for that business, more than we would normally per unit, because it took us into a new area that we didn't currently operate in. This is called the marriage value when you're selling businesses. This is the marriage value of putting the 2 together. If you think about when you're looking at marriage value as well, so another one would be WhatsApp. So WhatsApp was doing something like 350 million in revenue, and it was doing, I'm thinking of Snapchat. Snapchat was doing about 350 million in revenue and burning about 500 million a quarter, but it sold for 28 billion because the people who wanted to buy it were doing a different investment model, which is the next one I'm actually going to tell you about. WhatsApp is the one that I was going to tell you about. WhatsApp was acquired by Facebook. WhatsApp was doing 300 grand a year, £250,000, 300 million a year revenue, or 250 million a year revenue, 300 million a year costs. It was losing money, and it sold to Facebook for $18.2 billion. And everyone was like, this is ridiculous, they're never going to make their money back. How does that make any sense? Because anyone valuing it as a technology company would have been looking at what revenue they could achieve from basically advertising. And as we all know on WhatsApp, that's not huge. However, if you're Facebook and you make an acquisition of that, and you can then basically access people's information, their network, their communication platforms, you can own that communication space, so then you can absorb a competitor who's not going to compete with Facebook Messenger, and you can knock your competition out of the market. Not only is that a marriage value, which adds additional value, which half justifies that, equally, Facebook have got such huge market capital. If the acquisition of, and this is when you start getting into share values and capital markets, which is definitely one for another call, but when you get into the share market, it's not about profit and loss. It's not even about balance sheet. It's about shareholder value. It's about how do you get those shares to spike in value? How do you get the market to get excited? If Facebook got a 0.5% increase, I think it was, on that day from their share value, because people got excited, they just bought like one of the biggest communication platforms, although it was losing money, that then spiked the share value. Facebook would have doubled their money straight away just by like a 0.5% increase. Don't quote me on these figures, but this is like to illustrate the point. A tiny increase in their share value justified the acquisition of WhatsApp. So that was, it's all relative. So that's the second one, is the marriage value. If you can find somebody who's going to buy your business and it means something to them, that it means more to them than it does to anybody else, because the sum of the parts, the sum of the total is worth more of the parts, that gives you another value, to give you a higher value to actually consider an exit. How you doing, David? So if you can find the marriage value and find somebody it's going to be worth more to, that's the second type of valuation. And then the third one, there's loads of different types. The third one I'm going to share with you today is basically speculative values. So speculative values are all about playing the markets. So this is done a lot in the capital markets. It's done a lot in the share sales. The big space you're seeing this at the moment is in technology. Like, without a doubt, the technology space is not hugely dissimilar. Technology, crowdfunding, the market conditions there and the sort of shifts and the curves we're seeing is not hugely dissimilar to what we saw in like the dot-com era, where there's this element of madness to what's going on. And what's happening here is what's called the speculative valuation. So this is people investing and playing for the long game. They don't draw dividends. The company's worth no cash flow at all. I think Warren Buffett says, if Warren Buffett, Kevin O'Leary, all of your dividend investors, Berkshire Hathaway, they say if there's no cash, if there's zero cash flow, say no. They play that game. Other people play the speculative game, and this is where people are buying shares today, and they're creating what's called shareholder value, and they're playing a big market, a big game, a long game. And this is where they're putting money in and riding the curve on share prices, on market capital valuations, on this concept that things should get somewhere. If you look at businesses at the minute that aren't making any profit, aren't releasing any dividends, aren't making any cash flow, but are continuing to raise funds and continuing to increase their capital value, it's people like Uber. So Uber's a huge one. The P&L is not looking fantastic for Uber at all. But the share value, based on speculation, based on the fact that people think that it will take over the world, it's got this land grab strategy that it's going for, they're speculating that at a time in the future, these shares will be worth more. And some people trade that along the way. And if you're running a PLC, a lot of it is about shareholder value rather than P&L and arguably balance sheet to a degree. It's about keeping that share value going up. Amazon, for example, Amazon deliberately doesn't make profit. Like, it's part of the intention. Jeff Bezos is not happy if they do a quarter and make profit in the main. Like, he wants to reinvest that money. He's playing the long game on these share values. Tesla is another one. Tesla, I don't know the up-to-date figures, but Tesla's doing something like 4 billion in revenue, burning through 400 million a month in sunk costs. So it's just burning cash. It's not making a profit. It's burning through money. It's building like, your big, what are they called? The big battery place. It's irrelevant really, but it's going to annoy me. You know the one I'm talking about. As one factory, it makes more batteries than the whole of the rest of the world combined. It's this end-to-end power plant. It's going to be decades before that sees any net profit, but it's backed up by the capital values. Elon Musk himself says, for a company doing 4 billion in revenue, losing 2 to 300 million a month with a cash burn, it's crazy that it's got a market capital valuation, and I don't know the up-to-date figures, of something like 28 billion. So it's losing 300 million a month. It's doing 2.8 billion in revenue. Obviously, this is, again, an example. You have to sense check the figures. These are like figures from like earlier in the year or last year. But its market capital valuation is in the tens of billions. Elon Musk himself says this makes no sense. It seems pretty high. Oh, the Gigafactory. Yes, Dan. The Gigafactory is what Elon Musk's building in the middle of the desert. End-to-end production. Raw materials go in, finished cars come out. These are speculative markets, and this is where people are playing the shareholder value game rather than the P&L or the balance sheet. So hopefully that gives you some insight into different sorts of company valuations. The reality is a company's worth nothing until the cash is in the bank or is raised against the assets or is floated on a market, capital released, some sort of liquid entity entering the business. The reality is a business is worth what somebody's willing to pay for it. And you want to figure out, my recommendation to you going into this would be, think about who you're going to sell to. So think about are you going to sell to in your market. Is it going to be an investor who wants to see a multiplier of profit? Is it going to be a competitor or a supplier or somebody else in the market who wants to own that space and vertically or horizontally integrate? Or is it going to be somebody who's speculating, a crowdfunder, a high-risk speculator, somebody who's going to use tax breaks to take high risks through EIS or CIS, something like that. Somebody who's going to speculate and ride the wave with you. So the first thing is who are you going to sell your business to? Then think about why are they going to buy it. So this is really important. Why are they actually going to buy your business? And just think logically about all of this. Why are they going to buy it? Some people will buy businesses for revenue because it's cheaper than hiring a sales and marketing team. If you've got a good, solid pipeline of investors, deals, off-market XYZ, customers, clients, supply chain, contracts, that'll be worth something to somebody because it could be cheaper than them going out and having a sales and marketing team to actually do that themselves. Have a think about who you're going to sell it to and why do they want to buy. And just think logically, how do I justify this? Some people present me with companies, they're like, here you go, it's doing 100 grand revenue, it's making 25 grand profit and we value it at £500,000. It's like, well, that's interesting, that's cool. How do you come to that valuation? Just use logic. Don't say, well, it's a 10 times profit valuation. Well, where's the logic in that? How does that make any sense? These are 1-year management contracts, or they're 5-year leases, or they're leasehold flats with a depreciated valuation. Just think really logically about how all this comes together. So who are you going to sell to? Why do they want to buy it? And then logically think what price seems logical. Like, that's it. Think about what price seems logical. You might have a business that's making no money at all, no profit. And if you sold it on a multiplier of profit, it's worth next to nothing. But if you developed a load of assets, or you've got a load of plant, or you've got a load of assets on your balance sheet, you've got a load of future, you've got a huge growth opportunity, you're currently supplying your supplier and charging a premium and creating a bottleneck or a barrier to entry to another part of the market. Think logically about think logically about who could you sell it to and what's it worth to them. And think the best person who would buy that. And put all of that together and hopefully they'll give you some insight into how you're going to get to. When you're thinking about this, don't set yourself up for failure. So if you're thinking about an exit or you're thinking about raising funds is easier. Like, you don't actually need to know a valid... If you're going to go and use company valuations to raise money, you can use the speculative model all day long because it's a very active space. The capital markets are very active, crowdfunding, peer-to-peer lending, EIS, CDIS. You can use speculative valuations there to go and raise money for your business without a doubt. We raised a £1 million valuation for Multi-Let UK in a new holding company through an SCIS, and it had done zero revenue, and it was valued at £1 million. That's mad. But that's the speculative market because people are buying based on tax breaks and speculation. Luckily, we have gone through that, we've scaled through that, we've far exceeded that valuation, but that was a punt at the beginning. That was a punt 3.5 years ago that an investor made. That was speculation. Think about who you're going to sell these things to. Think about why you need to know the valuation, and don't spend your time and money building things in the business that aren't worth anything. I use letting agencies because we buy quite a lot of letting agencies, and it's an active space that I'm very familiar with. I get involved in some of the negotiations for the acquisitions, and if your plan is to sell to a corporate or to sell to a big competitor like Multi-Let UK, if you're going to sell to somebody like that, or just a local competitor, whatever, the value is in the management contracts. The value is in the revenue. Don't spend 3 to 5 years getting the team right, getting a nice set of offices, investing heavily in the brand, if you know that the person that's going to acquire you has no interest in that. You'd be better off selling now, whilst it's a bit rough around the edges. They can take the portfolio, they can take the stock and integrate it with theirs. If that's the person you're going to sell to, don't waste your time, energy, blood, sweat and tears in trying to get the business polished to sell it. Equally, if you want to build this thing up and sell it to a lifestyle entrepreneur, so say you want to build a letting agency and you want to sell it to somebody that's retiring, they've got, they've got whatever, a couple $100,000 in the bank, they want to buy a business, run it 3 days a week, earn themselves 30, 50, 60 grand a year from being a lifestyle entrepreneur, and you want to sell a business in a box, then don't try and sell them something that's half cooked. You need to understand what you build. Like, you want to build to sell, really. If you're building to sell, you want to build by intention, and that means understanding what your exit market's going to be reasonably early on, really. And most of your markets will be an investment market. It will be the stock share sale market for multipliers on profits, dividends, things like that. It will be competitors who want to do land grabs, go into new areas, acquire you to knock out the competition, increase their revenues without having to increase their marketing and sales costs. Or it'll be suppliers, it'll be people who want to vertically, horizontally integrate, all of these sort of things. Think about who's going to buy you, think about why they want to buy it, and then think about logically, what would they be prepared to pay for this business? And just think about it logically. If you can have a logical conversation with someone and say, this is what my business is worth, this is why it's worth it, and commercially, here's the logic behind it, not not chapter 14.2 out of the accountant's blue book of how to value businesses. It's like, logically, we're business people, we're entrepreneurs, here's a business, here's an opportunity, this is where the market is, here's the business plan, here's the profits, whatever. This is how it makes sense. That is going to be what your business is worth. And don't spend your time building something to sell if the person who's going to buy it doesn't want the things you're going to invest in. Right, ladies and gents, with that in mind, I actually have an acquisition to work on this afternoon, so I'm going to go and have a little play with that. If you want to know anything else about company valuations, profitability, EBITDA, scalability, brand, raising finance, EIS, CDIS, just drop me some comments in the video. Let me know what you want to know, and I'll gladly jump on there and give you some support. Very best of luck, ladies and gents. Darren, nice of you to join us. Congratulations on your Ironman. I'm literally finishing now, so watch the video. Let us know if you've got any questions, and I'll catch you all later in the week for another Midday Mentoring. This one's been Company Valuations. Check out the YouTube channel, which has got all of the Midday Mentorings on. Have a little flick through there. Some are 5 minutes, some are 50 minutes. Have a flick through there, get lots of value from it, and watch the Gold Rush webinar from last night. It's an absolute banger. Catch you later, ladies and gents. Have a great Wednesday. Catch you later.